Welcome to this week's Ben's Market Insights. We're going to be looking at Trump's visit to China and the implications for the global economy. We're also going to look at potentially the leadership challenge in the UK by Andy Burnham to Keir Starmer's premiership. But before we do that, let's immediately kind of have a chat about our YouTube channel. We'd love to have more subscribers. Please subscribe and like. Thank you very much. So, in terms of Trump's visit to China, for me, the biggest highlight was the President Xi speech where he brought up Thucydides' trap, which clearly got President Trump, as well as his advisors, and probably 99% of the rest of us to go and find a Google search engine to find out what the Thucydides trap was. I thought it was a very clever move by President Xi, because what it is essentially talking about the Peloponnesian Wars in ancient Greek times when Athens was fighting Sparta. And it was a case of one existing empire being attacked, if you like, by a new and up and rising nation. And invariably this ended up in war. So it felt to me that President Xi was both preparing and presenting a marker in the sand for the US in terms of China's rise and accelerated positioning in global economy, but also at the same time suggesting that they could collaborate and grow without having to go into any kind of tension and conflict, presumably talking about Taiwan there as well. But what it did bring up in my mind was that to a large extent, prior to the capex spree in terms of the AI spend beginning roughly around 2022-23, the US economy was showing signs of stagnation, was showing signs of deceleration, and a sort of a polarization, a social polarization, which was creating significant political unrest in the country. But at the same time, there was a rejuvenation in China. The Belt and Road Initiative was really creating quite a substantial amount of global ascendancy for the Chinese economy. But what happened since then, since the capex war or expenditure frenzy began, it's given a new life and a new sense of purpose to the US economy. They are by far and away re-accelerating their growth on a global basis and becoming the center for technological advance and innovation. And I think that that's actually sort of breathed life into the extension of the US empire, if you like, potentially in the short term at least at the expense of that Chinese ascendancy. And in fact, the Chinese economy has to some extent suffered those implications. But what it also implies is that, in a sense, this market rally that we're seeing is a subliminal and subconscious, if you like, sort of impression of the extension of the post-war Western establishment and cultural positioning. And I think that was something that was eroding away. And I think this AI supremacy and incredible amount of capex that has gone into it is spurring this next phase of potential growth. Now, I think it just extends the time for when China becomes a supreme power, if you like, on a global stage, just simply because they don't have to spend that kind of money. They just literally need to step into the footprints that the US has left behind and develop their AI supremacy and knowledge base just simply by following what the US has done on a much lower capital base. So it is an interesting play that President Xi did try and present China as chasing the US up this new empire, this tectonic shift in new empires. But I genuinely think that the US has built itself a re-acceleration, at least for the next 5 to 10 years, and hence the, again, overexposure in terms of asset allocation to the US economy at this juncture that we've been talking about. Jumping into the UK, a very different story. Clearly, there has been a very significant and quite toxic battle for the premiership of the Labour Party and therefore becoming Prime Minister. Of the 330 odd members of Parliament, Labour don't seem to be able to find a single potential leader, hence going out to try and bring Andy Burnham, Mayor of Manchester, on board to win a by-election in a seat so that he can become an MP and potentially challenge for the premiership. We just kind of wanted to take a look at a little bit about the announcements and the statements that Burnham has made in the past And for us, that's sort of suggesting a shift further towards the left in Labour's positioning. Burnham in the past has talked about a 10% base, a lower tax band, and then a 50% upper end tax band. He has criticised Reeves' attempt to reduce the welfare state and cut back on spending. And at the same time, it's been relatively light in terms of some of the statements he's made on immigration as well. So I think we really kind of need to look at the very basic mathematics of the economy. It is important to keep in mind that in the 25-26 budget, projected spending is running at something like £1.37 trillion. More than 50% of that is going towards the welfare state and increasing at quite a substantial pace. At the same time, the tax take and national insurance take, and plus other revenues coming from local councils, etc., comes in at about £1.23 trillion, leaving a £133 billion gap, which has to be funded by the bond markets. Now, supporters of Burnham have suggested that the bond markets will have to play their role and will have to effectively do what the UK government wants them to do. That doesn't work like that, as we all know. The markets set the rate, and in fact, we talked about this last week, that in the UK, a 30-year a gilt auction had a coupon of some 5.58%, which was the highest since 1998. Already, investors are getting a bit queasy about the funding gap that the UK government is developing here. So if we now have a new leadership which decides that the welfare system can expand still further, that borrowing can increase, then clearly that's going to put pressure on the government to continue to raise in the bond markets. That means higher rates in order to attract investors. And if they don't offer those higher rates, then there's clearly a weakness in the currency, as people believe that the government is not able to fund its way through its budget. Now, that has severe implications. Higher rates mean lower growth from an economic perspective. But if we don't see the higher rates and we see a weaker currency, then clearly that's importing inflation into the country. Neither is a particularly good outcome. So clearly, if a new Burnham administration comes into power, that might well be more pragmatic than the statements made in the past, but nonetheless, it is worth keeping in mind that there does seem to be a somewhat shift further to the left, which I think is going to be detrimental for the economic growth of the UK, and so we continue to remain underweight UK assets. It's also worth keeping in mind that from a micro perspective, we've had an incredibly strong performance from a low base for the ETF that covers the software stocks. It's called the IGV, a third of which is in four names: Oracle, Microsoft, Palo Alto, and Palantir. So each one has a particular case in point that may well have supported that bounce back. So the IGV is up some 15% this month alone, whilst the CTF has obviously been under pressure with the SaaSmageddon concern, and down 13% year to date compared to the semiconductor ETF, the XLK, which is up some 23%. Now, people are suggesting that the threat to the software industry is not as palpable as AI would have initially suggested. We've got a couple of interesting points on this. Again, I agree that it's not going to be a case in point that AI will replace all software. But I do think that at the margin, the incremental revenue growth that would have come from selling extra seats or customizing a platform is probably going to be substituted by agents that the company's own IT department will probably be able to augment their current platform. Take another example. If you look at the video gaming publisher world, a Call of Duty, a huge franchise for Activision now under Microsoft's umbrella, will not go away. But what would potentially happen is that players begin to create games of their own through agentics and through AI and play with those to some extent in time resource at the expense of playing on Call of Duty. That implies that whilst these software businesses and giants don't go away as franchises, they might see a significant incremental decline in terms of their growth opportunity. And so I think that this bounce back in the IGV should be taken with some caution. Have a great week. Speak to you next week.